Hey guys, Brian Stevens over here at Mortgage Shots. Listen, I got my good friend Chris Martin. He's over there with Oak Tree. Great non-QM lenders, our partners. We've been with these guys for a long time and they do a great job. We have some stuff about the industry I want to talk about. But right now, I want to get this straight, you're doing 90% investment loans right now? Is that accurate?
Yep. We're doing 90% CLTV, home equity lines of credit. For if you've got a 680 plus FICO score, you could hit this 90% CLTV on an interest only home equity line of credit for your borrower. Absolutely.
Well, hold on a second, but let's get into the details on this, because this is kind of a big one here. So that's going to be an 80-10 or an 80-10-10 type of thing.
You can do 80-10-10. You can use it to buy, or if you're sitting on your second lien, your first lien right now is 60 LTV. We'll let you go up to $400,000 loan amount on our matrix right now. We can go up to $500,000. We can go up to 90% CLTV. So if you've got an investor who has properties up to 10, they want to cash out and acquire new investment properties, whatever they want to do. We're able to help them with that. And you can qualify for any of our home equity line of credit products off of either full doc, so 1 or 2 year tax returns and pay stubs and things like that, or if you've got a self-employed borrower for the same hit for 12 months or no hit for 24 months for bank statements as well. So it's a great program. We don't discriminate if you're self-employed or if you're a wage earner, and you can get 90% on primary, second, home, or investment.
I want to jump in here because this is big to me. And loan officers, you have to understand this. We have to read the tea leaves of the market to let you know the direction it's going. According to a report that came out from Zillow just 2 days ago, it says 1 in 5 prospective sellers are considering becoming landlords. That means they want to move out of their house, buy a new house, and they want to keep their existing house. We still know that 46.5% of homeowners right now are deemed to be equity rich. Equity rich means that you have at least half of the value of your property in the form of equity. The numbers are overwhelming, meaning people are sitting on a boatload of cash right now. We know from NAR that 30% of the people are considering moving. If we could go 90% on an investment property, it checks all the boxes here. For the 1 in 5 prospective sellers who's thinking of becoming a landlord, it checks that box because they can pull out a smaller amount of money and keep that first intact because they have the equity in their existing home. Check that box. I mean, this covers so many areas where the market is headed right now. A 90% CLTV on an investment loan, Chris. I mean, this just opens up a whole new spectrum of potential clients for loan officers who are smart enough to go out there and just hunt these people down, right?
Absolutely. We have, we have a history of being innovative in our products, and we work with some great investor partners. And this is one of the products that they offer, and it's just something that we felt was right for the market and gives, with all of that untapped equity potential, it's something that we can lean on, and also, like I said, we do it on primary residences too. Okay.
All right. That was the CD product. Okay. Let's talk about that real quickly.
Yeah. Primary residence. One of the things when I was in the loan officer's shoes back in the day, and I was a sales manager running a sales team, we offered home equity line of credit products to our borrowers also.
Yeah.
We found out was not only is it a great product for somebody who's looking to access that equity and move out, but a lot of times people might be short on reserves. You're taking the 1003 and you're like, hey, how many reserves you got? Oh, I got 3 months. So they got, they bought their house. They're in the house for a while, and like something happens, the water heater breaks, or, some of the stuff would be covered under warranty. Some might not. Whatever the case is, things happen. Do you want to hit your savings account for your emergency fund, or would you like to have access to a line of credit? So it's a great way to add that security. So you do a loan for somebody, they're in the house, whatever the case might be, you still can use that second appraisal. With this product, you can go up to anything over, I'm just going to look real quick, I don't want to miss the guides. Anything less than 80% combined loan to value and less than $250,000 loan amount, we just do an AVM. So we don't need to have a full, appraisal done. But if you've done an appraisal in the last 12 months, we can still use that value. So if you've done a house for somebody 4 or 5 months ago, and you're like, oh, I know someone who'd be perfect for that product, we can do this for that. So otherwise, we need to get if it's over 12 months, we need to do a recertification of value and all that kind of stuff. But aside from that, we can do an AVM. We do a drive-by inspection. It is literally a drive-by. We take a picture of the house and make sure that it's still there. That it's not falling apart and in disrepair. But it's those two things. We can close these loans. There's no 7-day TILA requirement. TRID does not apply to HELOCs. So they're open-ended line of credit they don't work the same way as a standard first or second mortgage does. We don't use CDs. We don't use LEs. We just use a HUD settlement statement. It's a different type of disclosure. Obviously, you have to disclose the APR. there's not there isn't a limit per se on points and fees. We obviously need to be reasonable and customary, and we can charge. Obviously, you can charge. You can upsell the rates to get paid as well. So.
What about for our ever-growing pool of alt-doc borrowers out there, self-employed, 1099 borrowers? How do we approach that?
I mentioned that a little bit earlier, but we no difference in price between full doc and between bank statements. So
okay.
So if you're wage earner and you have a house, or you're self-employed and you have a house, and you want to do 12 or 24 months bank statements, there's a price difference to use 12 months versus 24 months of either one of the income doc types. But if you want to do that, you're more than able to.
So you got them covered over there. And listen, people are with the 1.3 or $4 trillion in revolving debt that we're carrying right now. A lot of folks are looking to they need to do debt consolidation. There's just a huge need for HELOCs. And you know, the one thing that I just always kind of found strange is you have secured debt and you have unsecured debt. What's going to be a better form of debt to carry? And so many people aren't using second mortgages right now. It just seems like that's the biggest missed opportunity in the business.
And up to, you have an income limit, and I'm not an IRS agent nor am I a CPA, so I don't want to quote, but you can, a lot of times in my experience, mortgage interest is tax deductible and credit card debt is not. So people, certain income brackets, there's a certain percentage that they can write off of their interest, or if depending upon where they're at, they can write the whole thing off. So I would definitely be using, mortgage debt to pay off credit card debt. I wouldn't necessarily recommend it for automobile loans, but if somebody really has a payment they can't afford, this is a great option for them.
Yeah, and you just think about it for a couple of seconds here. Where are you going to get the better terms? If that loan is secured against something, or if that loan is not secured against something. So it's not just a possible tax deduction for you, but your rate on it's going to be infinitely better. It's just an odd part of the market that's been largely ignored by our industry. I find it strange. Listen, check out some of their HELOCs, some of their second mortgages over there. These guys are fantastic to work with. And your turn times are killing it right now. I was just looking at some of your numbers right now. Your turn times where are we at right now?
We're around 48 hours right now. Obviously, we've seen the market start to pick up. I think that a lot of loan officers that have been doing this for a while realize that the market ebbs and flows. That killed in 2021. They killed it in 2022. And as the rates really started to rise, the middle of 2022 and on, they kind of, the borrowers were less responsive, and they weren't, I don't think there was as many engaged LOs, but I think now that the market's come back, the rates aren't really going to go as much lower anytime soon. But hey, people still need to eat. People still need financing for their homes. People still need money, right? That's one of the reasons when I was asked by my current business partner and one-time boss when he was interviewing me for my first mortgage job, he's like, why do you want to get into the mortgage industry? And I said, because people always need money. No matter, everybody always needs money. They need money for something. So what better to sell than money? So that's why I got in the business. That's why hopefully many of you are in the business, because there's so many unique opportunities that people have to help each other, that you can help people with. You can help them buy a house. You can help them put their kid through college. You can help them buy a boat. You can help them, whatever it is they want to do. They need to have cash. They need to have access to cash to do that. They want to build an investment portfolio so they have something to retire on. Most people don't, a lot of people don't trust the stock market. It's, they feel like it's being manipulated. They feel like there's abundance of reasons why you shouldn't trust the stock market than it is. I mean, it's very easily manipulatable. But real estate, is something that I think that we've seen. If you simply look at the housing market's done, I saw a chart you had up maybe a week or so ago, where it was just talking about, maybe it wasn't you, it was another, I was looking at another article. It had the housing bubble, and then it had like where we're at now with housing prices. And the Federal Reserve and anybody who can manipulate anything would love to see this go down here, because it makes housing more affordable. More people get the houses, and makes them look better. But that's not what's happening, and they can't. No matter what they do to rates, they can't. There's definitely proof that the real estate market is much more difficult to manipulate than the standard, stock market. So people want to put their money where things are safer, where things are, people are investing in investment properties because the housing prices are so high. It's so high, it's expensive to get a mortgage. So what do? You rent. So those people need to have a place to live, and that's who becomes your tenants until the housing becomes affordable again, which, I just don't see happening anytime soon.
Yeah.
Rates are high right now. They stay higher for longer. People aren't going to sell their houses until rates dip. And when rates dip, people are going to still buy houses. So it's I don't see really what the pressure is.
It's quite the paradox. I still think there's some resistance from loan officers. You just don't follow up with what you don't know or understand. But
Right.
the adoption of non-QM isn't where it needs to be, and it's just a missed opportunity. More arrows in your quivers, tools in your toolbox, type of thing. If you can't figure that out, I don't know why you're selling loans. But one of the numbers that really kind of stood out to me, Chris, is startup businesses last year were up over 24%. I'm looking at what's going on in commercial real estate right now. It's just getting clobbered, absolutely clobbered right now. So the ability for entrepreneurs to go out and pick up, cheap space rent and, start that idea, or maybe they've been in the space before COVID. There's a whole bunch of different scenarios. It seems like that's a big opportunity in our market right now, self-employed folks. What type of programs do we have available for our self-employed folks right now that are, obviously they're all specifically outside of agency loans, but what jumps out at you? Because I think there's a lot of loan officers who are watching this, frankly, who aren't even looking at these loans right now.
We specialize in 1099 loans. If somebody gets 1099, those gig economy workers, the Uber drivers, Lyft drivers, that kind of stuff, if they're using it even as a second form of income, that we do loans for those types of folks all the time. We actually I just had somebody in my office, and he was talking about, hey, I got a guy, I just submitted a loan for him. He's 21 or 22 years old. He's like, guess how much you made last year? I'm like, I don't know, how much did you make? And he's like, his 1099 was $500 short of $1 million. And he sells solar.
Really?
He's a solar salesman. It's Arizona. It's sunny a lot.
Right.
So he's done very well for himself, and hats off to him, but he can't get traditional financing, right? Unless he's not writing everything off and he's writing the tax man a big check every year. It's difficult for him to obtain financing because he's self-employed and he's young and everything else. But we have bank statement loans, 1099 only loans are a great way to go. We make exceptions all the way down, 18, 12 months of self-employment. We can get very aggressive for folks like that can show that they can make money and they have the potential of being a high income earner. But they just can't qualify for traditional bank financing. Fannie and Freddie have not accounted for them yet.
Yeah, I remember having a conversation with Dave Stevens like 10 years ago, maybe even longer than that he was talking about how underwriting guidelines for Fannie Mae and Freddie Mac needed to get overhauled because they're not taking into consideration what the profile of the current and future borrowers that we have today look like. Or, gone are the days of, getting the watch and the plaque and retiring after 40 years at Chrysler. Like, we all know this. This is old news. But what's strange is how many loan officers haven't really kind of adopted and made the pivots necessary to really create the opportunities for yourself with the profiles of new borrowers, these 1099 employees, these gig employees. It's this kind of a trip to me. With that said, we've got our 90%. I love the 90% on our investment properties. You guys should be calling the reps on that, on those programs. What are other big missed opportunities in the non-QM world?
Obviously, we've seen DSCR kind of ebbs and flows.
Okay.
Investment property buyers and things like that. Those properties are still on the market. I think that people should be really looking at those programs. We go up to 80% financing on those on an LTV basis. If you've got borrowers that are investors, you should be going after those borrowers. We will do up to 5 to 8 units. Again, blanket loans. A lot of people don't like to touch blanket loans because they're complex, they're cumbersome to work on, and we don't feel like that. They're complex loans, but we have experts that can take the time to get those done. So a lot of investors don't like writing. If they've got a lot of properties, they don't like writing a bunch of different checks to every single mortgage lender that they're doing business with. So it could just be as easy as, hey, let me simplify your life and have you write one check on a monthly basis. How are you going to do that? I do a blanket loan. I put all your loans together. And what if I want to sell? Yeah, you can sell. That's fine. You have to pay off 120% of whatever the existing lien that's tied to that property is, but that's it. Then you move on. You have equity in.
So what are the advantages of it? Is it not just ease of payment? What are the other advantages of doing a blanket loan?
Well, a lot of times you can do smaller loan sizes than what we would normally approve because you're doing multiple loans over multiple properties. So if you had a guy that had a $75,000 loan, you might not be able to do a $74,000 loan or something like that. A lot of lenders have cutoffs, but you can fit a couple of those in there if they're being offset with some other larger loan sizes. There are obviously you can sometimes get a better rate because you're qualifying against a broad array of properties, not just one.
Really? Interesting.
Yeah, so you're getting, it's risk diversification for the investor because they're just think about it. That's why they don't like to have huge exposure to one borrower necessarily, but if they've got multiple exposure over several properties, it's good for them. So, and then obviously the ease of making just the one payment is always helpful as well. So,
this is interesting here. So, as a loan officer, would it be smart for them, behoove them right now if we're trying to find a way to pick up business? It's very easy to go ahead and get a search and find people who own 5 or 6 properties to reach out to those folks and look at a blanket loan as an option for them. You said because you've got diversified products, it kind of makes sense that there's going to be less risk. It's not like everything is going to collapse at once.
Right.
So you're seeing competitive rates for these blanket loans?
Absolutely. I couldn't get one off the top of my head, but I know they're competitive. Yeah, absolutely. And again, or if they have a situation where they had a super high blanket loan because they took it out with a different private mortgage company and they want to break it out and have into individual loans because they don't want to have to pay off 120% to sell their house, we can also refinance out of a blanket loan. So there's, just depends on the customer situation. Everyone has a unique situation. We do both.
Do you write many of those?
Probably 2 or 3 blanket loans a month, which if you take it over the account of all the volume we do, that's not really a lot as far as unit wise, but when you look at how many properties are in each, it's fairly standard.
I gotta say, like from a loan officer's perspective, I always say you got 12 eggs in a day. Each egg represents 45 minutes of your workday. So every 45 minutes, you got to smash an egg, and when your dozen is gone, your day is over. How are you going to spend your time smashing your eggs over the course of the day? Why wouldn't you take 45 minutes, smash 1/12 of your day, and run down some of these blanket loans? I mean, this is just marlin fishing to me. Like, if I'm going to go fishing, I don't want to catch bluegill. I want to go catch a marlin. I want to catch a great white. This is great white fishing because you could go in there and do a blanket loan on 7 or 8 properties, and that's the equivalent of 7 or 8 different loans.
One other thing that I just thought of when you were thinking about marlin fishing is that on our HELOC program, what we found is that we have a fairly higher than average loan size for us, and we found that it's challenging. So we have a lot of clients that have done $2-3 million loans with us, and then they want to do a second. And they're like, "Oh, sorry, your maximum exposure is like $2.5 million." So meaning that your first mortgage and your second mortgage can't be more than $2.5 million combined. And if they're already at $2.5 million, then we can't do a second.
Right.
This program, this HELOC program, our maximum exposure is actually $5 million. So you could actually, if you had a $2.5 million house or loan already, we could actually go to $3 million. Or if you had a $4.5 million, we'd go to $5 million. So our max exposure is $5 million. All liens on title. So that's another kind of niche that no one's really looked at. So,
well, I mean, listen, that is marlin fishing. But if you find yourself neighborhoods where we live, I've got $300,000, $400,000 houses 10 minutes away down the road over here, and I got medium price $2 million houses on this side. So we've all got different communities within the areas that we service. And if you're in some of those high cost, high value areas, I mean, check out these loans. I mean, it sounds like a great idea. Chris, what are we missing today?
I don't know. I think you hit on everything.
Chris, thanks so much for your time, man. I appreciate it.
Thank you, Brian. I appreciate you.